Hello, everyone, and thank you for joining this week's Taxes in Retirement Facebook Live session. As promised, this week's topic will be Backdoor Roth IRA contributions. We will get to that in a minute. It is 8 o'clock on the dot here on the East Coast. We'll give it another minute. And as last week and the week before, I will start with a few dad jokes. We have a special request, actually. We have a write-in joke from one of the group members that I approved of, stamped and approved, so I will be reading it for you now. It is, if a carrot and a cabbage were to have a race, who would win? The cabbage, of course, because it's a head. Get it? Head, yep. All right. Next, here's from my little box of dad jokes. A termite walks into a pub and asks, is the bartender here? Because termites eat wood, you know? Is this thing on? And finally, this is my favorite. I needed a password 8 characters long, so I picked Snow White and the 7 Dwarves, because there's 1, 2, 3. Anyway, hope you enjoyed those. Those are my dad jokes for this week. There's a comment, so I see the comments are working. As always, feel free to comment or post questions along the way. There is a 15 to 20 second delay from when you post it till when I see it. So if I don't reply promptly, that's probably why, or I'm just not seeing it because I'm in my groove spitting out interesting stuff about taxes and retirement. But again, feel free to post as you see fit. All right, so this week is again Backdoor Roth IRA contributions. As we mentioned last week, there's about Roth IRA withdrawal rules. There are really just 2 ways to get money into a Roth IRA. The first is directly contribute it. The second is to do conversions. Contributions, there's a couple conditions to do that. Well, first, you can contribute up to $6,000 a year in 2020 at least if you're younger than 50. Or $6,000 plus another $1,000, what they call catch-up, so $7,000 in total, if you are 50 by the end of 2020. So your birthday can be December 31st, you turn 50, you're eligible to contribute $7,000, up to $7,000 for the year, for 2020. Now, those contribution limits can and do change. They go up in $500 increments, so basically not until there's enough inflation that has since elapsed that it's $500 higher than what the previous limit was, only then will there be a bump up in the size of those contributions. So they were just increased in 2020, or maybe it's 2019. Prior to that, it was $5,500 as opposed to $6,000. So there was a $500 increase on that. In order to directly contribute, there's really 2 conditions. One is you need earned income. Earned income basically means you have a job that pays you wages or you're self-employed. Even if you have $30 million sitting in your bank of just cash doing nothing, if you don't have earned income, again, wages or self-employment income, you're not eligible to directly contribute into a Roth IRA or even a traditional IRA for that matter. The underlying requirement is you need earned income, and you can't contribute more than your earned income. So for example, I don't know, you worked 1 day this year and you made $2,000 total. It's good for you if you made that much, but whatever. You made $2,000 total for the year, either in wages or self-employment income. The most you can contribute to an IRA or Roth IRA for the year would be $2,000, up to your earned income. So assuming you earned at least $6,000 or $7,000 for the year, you can potentially make your full $6,000 or $7,000 contribution. Again, $6,000 if you're younger than 50 at the end of the year, $7,000 if you're 50 or older by the end of the year. So assuming you have earned income, even then, not everyone can directly make a contribution. So here's in little chart form, again with my hokey clipboard here. So assuming you have enough earned income, you can just take cash from your bank or brokerage account, wherever your cash is currently sitting. You put it in after tax, meaning all the money that's in here, you already paid tax on. So you take that money and boop, put it directly into your Roth IRA. This is a normal contribution. Now, a question was asked in the group a week or so ago, can I contribute stock, shares of stock to a Roth IRA? The answer is unfortunately no. You can only contribute cash. Now that could be actual bills. Now, honestly, I don't know if you can mail in physical bills. My guess is probably not. But cash doesn't mean just bills. Cash means you send in a check, you wire from your bank, you do a ACH bank transfer, whatever. That's all cash. So people who are eligible, this is the simple, neat and pretty process to make a normal or regular, whatever you want to call it, Roth IRA contribution. But if you have over a certain amount of income, you get basically stopped out or phased out is the proper tax terminology from being eligible to make a contribution. So you can find these limits everywhere. Just Google like Roth IRA contribution limits. There's nothing special, but I do have this in table form just to show you don't get too hung up on memorizing these, because again, it's publicly available. So for 2020, for example, if you are, let's say, married filing jointly, and collectively, you and your spouse, your modified adjusted gross income is below $196,000, you can make your full contribution. So again, $6,000 if you are under 50, $7,000 if you're over 50, or 50 or over, sorry. And these apply to each spouse. So let's say the two of you together have a combined modified adjusted gross income of $180,000, so you're under that limit. You can each make a $6,000 or $7,000 contribution for 2020. Just backing up briefly, what is modified adjusted gross income? You've probably seen that label before. I forget the figure. There's something like 10 or 12 different definitions of modified adjusted gross income within the tax code. So depending what particular provision you're talking about, it's going to be slightly different. So the version of modified adjusted gross income used for purposes of these Roth contribution limits is different than what it is for making regular deductible IRA contributions, which is different from what it is for Medicare premiums that we discussed a handful of weeks ago, etc. There's a long, I assume anyone, whether you do your own taxes or use someone else to do it, there's going to be software that does it. But if you're interested, this is the actual calculation of modified adjusted gross income. It starts with your regular adjusted gross income from your tax return, and then adds or mainly subtracts a bunch of different things. So for example, one of the more common ones that people might get hit with is if you took a deduction on your regular tax return for interest you paid on student loans, you have to add that deduction back in. So it's going to increase your modified adjusted gross income from just what your adjusted gross income was. So anyway, don't get too hung up on that. Again, it's all calculated in your software, or by your tax prep person will have all this stuff for you. So that's, if you're below that limit, you can make your full contribution. Let's jump to the end of it. If you're over, if collectively married filing joint, your modified adjusted gross income is equal to or greater than $206,000, you can't directly contribute it all to a Roth, not even 1 cent. If you do, it's an excess. You're going to have to pay 6% on whatever excess contribution you make that you weren't eligible to make. And then between 196 and 206, there's this phase out period. I won't get into the math, but the figure ranges from 0 to your full $6,000 or $7,000 contribution if you're within that. And then for single, you can see here the limits obviously aren't quite as big as they are for married filing joint. Couple questions. All right, let me stop there for a second. A few questions. And we should say I want to convert 403B money from a former employer to Roth. Does that entail selling the funds and then purchasing them in the Roth account? I would rather not sell now. Is there a way to convert? Good question. And we should, chances are, yes, you'll have to sell unless the custodian of the 403B plan is the same custodian as where your Roth IRA is or is going to be. In that case, if they are the same spot, they may be able to just transfer the securities in kind, and whatever the value of those collective positions are on the day they transfer, that will be the dollar amount of your conversion and how much you'd have to pay tax on. But I'm guessing there's probably a decent likelihood that 403B custodian may be an insurance company or something, depending what type of 403B plan it is. So you're probably not going to want to open your Roth IRA there, even if you can. Probably do it at one of the the large name. I can't give specific recommendations here, but any of the big, large, low-cost brokers or custodians that most people have heard of, you would probably open your Roth IRA there. So in doing so, since you're leaving one custodian at your 403b to go to another one for your Roth, you'll most likely have to sell whatever's in your 403b at the time. So that goes to then a big pot of cash. The 403b custodian then sends that money, probably by way of paper check, to the custodian where your Roth IRA is. Or maybe actually it will go to you. You need to turn around and flip it over to your Roth IRA. But I don't know for certain, but chances are, yes, you'll probably have to sell whatever's in your 403b. Now, I wouldn't necessarily worry too much about that. There is going to be some period of probably a few weeks you're out of the market in whatever you're invested in. Could be good, could be bad. If coincidentally the day you sell it, the market tanks after that, then hey, you made out well. You locked in a relatively higher price. You get that cash. You then reinvest it. When it gets to your Roth IRA, that could be in your favor. The flip side would hurt you, obviously. If you sell everything and then the market goes on a tremendous tear, you missed out on that. But there's really not much you can do to avoid that if you do have to indeed liquidate it. It is what it is. Julia, would severance pay be considered for wage income? Great question. I think so. Probably, maybe, depending how exactly it's structured, it may not. But if, for example, where it would be wages, I guess there's a lot of possibilities here, but in essence, an employer can basically just pay you out for 6 months and keep you on their books for 6 months, even if they ask you to leave today. I've seen that happen where I've worked before. In that case, yes, that's wages. It's simply, you're getting paid. It's as if you're there, even though they're telling you to stay home. That's definitely wages. I don't know for certain. I guess my answer is depends on the nature of how they structure that severance. It may or may not be considered earned income for purposes of IRA contribution eligibility. So Anwisha, yes, it is the same custodian. So ask, call them up and ask. There's a chance they may be able to just convert your securities as they are and have you pay tax on the value of what was converted. So there you go. Julia, you received it bi-weekly like a regular paycheck. Yes, so then your severance pay is probably considered earned income. Don't quote me. Again, I don't know without seeing it. But it's probably, maybe you can ask your employer, HR department, previous employer, HR department, how that's going to show up on your W-2. If it's just going to be lumped in your box 1, your wage income, then yes, there's your answer right there. If it shows up anywhere else on your W-2, then I don't know the answer. It would kind of depend. All right. So again, going back to, let's assume you're over these limits, whether you're married or you're single, and your modified adjusted gross income is over the limits such that you cannot directly contribute to a Roth IRA. So you are not allowed to do this. Big X through that, can't do it. You have too much income. So then what? Well, this is now where the backdoor Roth contribution comes in. Basically, it's like the table before. Whereas this was one neat and pretty step, you take your money right from wherever it is, bank, brokerage account, whatever, just bloop, plop it in after tax into your Roth IRA. Now, there's additional step in the middle. Let me get this straightened out here. So you're starting at the same spot. You have cash. So this again assumes you have enough earned income. You need at least, like I said, $6,000 or $7,000 of earned income to do this. And here's why. You have your cash sitting like before in a bank or brokerage account. The first step is you make an after-tax contribution to a traditional IRA, not a Roth, but a traditional IRA. Now here's a real big assumption that we're going to make. The assumption is you have only one traditional IRA in your name, currently open, and there's nothing else in it at the time. So you have just an empty traditional IRA sitting there hanging out, nothing in it. May not be realistic, but just assume that for now, and I'll explain in a bit why that matters. So you take your cash, you deposit your $6,000 or $7,000, whatever, after tax in traditional IRA. Now this is where things get slightly different. So I assume most of you know that traditional IRAs, the draw of them normally is that you put money in on a pre-tax basis. So if you contribute $6,000 today on a traditional tax-deferred basis to a regular IRA, you're able to reduce your taxable income by $6,000 this year. That's the upside. The downside is once it's there, you have to pay tax eventually, and that's sort of the whole premise of taxes and retirement and my whole shtick and what I do in my retirement planning, investment management business. It's all about tax-efficient retirement planning and structuring accounts tax-efficient way, making withdrawals tax-efficient, getting ahead of taxes, taking advantage of low taxes, etc. That's the downside of tax-deferred stuff. You're going to have to pay tax at some point, maybe out of your control, and who knows how bad taxes will be in the future, so why not try to get ahead of it? But anyway, in making a traditional tax-deferred contribution to a regular IRA, there's also income limits on that. And they're not the same limits that I just showed for Roth. They're loosely comparable, but not the same. If your income is above those limits, you're knocked out of eligibility to make a tax-deferred contribution to a traditional IRA. But anyone, regardless of income, you could be making $20 million a year, anyone can make an after-tax contribution to a traditional IRA, simply meaning you put your $6,000 or $7,000 in and do not take a tax deduction for it in the year you do it. That's an after-tax contribution to a traditional IRA. Again, anybody can do it. You have to have earned income again, at least $6,000 or $7,000 to put in the full amount, but there's no cap on how much income you can have if you're doing it on a non-deductible, aka after-tax basis. Okay, so that's the first step. Then, and again, remember, we're assuming this is your only IRA and there was nothing else in it prior to you putting in your after-tax money here. Let's assume you did $6,000. The next step, as soon as your custodian can process your instruction to get the money out of there, you can then convert it. Let me get this closer. You can convert the money you just put in after tax, already pay tax on it. You can then convert this to your Roth IRA. The end result, you took $6,000 of cash, it ended up in your Roth IRA, and you already paid tax on the money, which if you look here, it's effectively the same thing. $6,000 ends up in your Roth IRA, already paid tax on the money. The difference, you got this whole thing going on here. You got one extra step in the middle. This is, let's say, getting money into your Roth through the front door, straightforward, not hiding, nothing out of the ordinary, just boom, walking right in. All these goings-ons here, that's the back door. The end result's the same, money gets into your Roth, but by way of the back door. This whole process here is colloquially referred to as the back door. Good? Make sense so far? So, again, anybody can contribute money after tax to a regular IRA, assuming you have earned income, and anybody can do a conversion from a regular IRA to a Roth, regardless of your income. Even doing a conversion, you don't have to have any income at all. Whether you have zero income or $20 million a year, anybody can convert, but only people who have earned income can do the contribution in the first place. So, good. Again, end result, money gets into your Roth, you pay tax on that money, but you have one extra step in the middle. This is the backdoor Roth IRA contribution. In a nutshell, it's basically for people who make too much income to contribute to a Roth directly. They can do it this way by way of the proverbial backdoor. Done. Again, this, like I said, the big assumption here was this is your only traditional IRA you have in your name, and there was nothing else in it before you put in the after-tax money. If you do that, this whole thing works, splendidly. I didn't do a slide for it, but I'll just sort of talk through it. Here's the trouble if you have other monies already in your traditional IRA. There's something called the pro-rata rule, and here's the rub. Here's the problem with that. Any money you take out of your, so let's assume you already had this IRA open and there's $100,000 of traditional tax-deferred money in it, right? So prior to you doing your first step in your backdoor contribution, you had $100,000 sitting here from years worth of regular tax-deferred contributions. So you have $100,000 pre-tax money sitting in here. You then add, $6,000 after tax, right? And your intention is take that $6,000 you just put in that you already paid tax on, move it over by way of the Roth conversion. And in theory, if we go back to our previous example where there's nothing else in here, you don't have to pay tax again on the conversion because the money was already taxed before it was converted. So you're not getting double taxed on it. Now, if you have 100 grand of pre-tax money sitting here, you can't, and you add 6,000 after tax into it, you unfortunately cannot just cherry pick out the 6,000 of after tax money and choose to move that, choose to convert that to the Roth. Because the pro-rata rule says that any dollar that comes out of a traditional IRA is deemed to be equal parts, pre-tax money and post-tax money based on the percentage of what the total makeup of this is. So let me use some better numbers to keep it easy. Let's assume there's $94,000 of pre-tax money here, and you add $6,000 of after-tax. So you now have $100,000 total after your after-tax deduction. 94% of that is pre-tax money. That's the 94 that was already in there, tax deferred. Only 6% is after-tax. So when you go to convert $6,000 out of this IRA into your Roth, you can't say only convert the $6,000 I already paid tax on. It doesn't work that way. The IRS is going to say of that $6,000 you're converting, 94% of it is pre-tax money that's never been taxed. Only 6% of it is after tax. So of that 6,000 bucks, got a calculator here, times 0.94. So 94% of $6,000 is $5,640. So of the $6,000 you convert, $5,640 of it is going to be considered a conversion of your pre-tax money, and that will be taxable in the year you convert it. On top of you already paid the tax on the $6,000 you first put in. Make sense? This is where things get a little squirrely, and it's slightly difficult to grasp unless you actually really sit and think through it, or calculate it out in the tax form. It's form 8606 is the one that you can see this all come to life. It's lots of lines. It's 2 pages. It's not a fun one, but that's the most important piece of a tax return when you're doing conversions, and for this reason, because it calculates this idea of pro rata. Again, pro rata is every dollar that comes out of a traditional IRA is a mix of after-tax and pre-tax based on the proportion of how much of that total account was after-tax versus pre-tax. You can't skim and cherry pick. I did a YouTube video on it. I posted up a few days ago. It's called How to Do a Backdoor Roth Contribution, I think. It's everything I'm discussing here in sort of more slides, and I do have a slide and a sort of step through of how the pro rata thing works. But the best way to think about it is the concept of pro rata is putting, let me stop covering my microphone, is putting cream into coffee. So let's assume you have a cup of coffee, black coffee. That's analogous to an IRA that has only pre-tax money in it, right? Money that's never been taxed. You've taken tax deferrals on everything you put in there. That's coffee, black coffee. You have a little thing of cream. Here's the coffee, here's the cream, relatively small. Consider cream the after-tax money, the stuff you already pay tax on prior to putting in. Before you put the two together, they're separate and distinct. It's easy to say, yep, here's my cream, yep, here's my coffee, blah, blah, blah. Once you take that cream, pour it into the coffee, what happens? It all swirls together and it becomes this, light brown mocha-ish color. Once that happens, boom, you can't, laws of physics prevent you from, or biology is it, whatever. You can't just, once you mix it, you can't go, even though 94%, 94% of your cup is now black coffee, the other 6% is the cream. Once they're together, it's this one big homogeneous mix. You can't simply skim out, oh, nope, take it back, I want my cream back, let me take that 6% out. You can't do it. Every little spoon or drip or sip you take out is going to be a mix of 94% coffee, 6% cream. That's pro rata. You can't just get your cream out at that point. Now you technically can, there's a workaround, and basically it involves, if you have an employer plan like a 401k, you can take this mixed up mocha colored cup of coffee with cream in it, give it to your 401k provider. They have processes where they can basically push it through a filter. When you take that IRA money, put it into a 401 plan, it has to get mashed through this filter that does indeed segregate the coffee from the cream, because in your 401k, it's going to have a regular pre-tax account, it's going to have an after-tax account. By law, they can't commingle in there. So you have this homogeneous cup of coffee, mush it into your 401k, that will split it out. From there, you can then separately, re-roll them out to different accounts if you want or whatever, but that's the only way around it. If you don't have access to a 401k or other employer plan, then you don't have that option available to you, unfortunately. Once you mix your cream in your coffee, it's done. It's this homogeneous mix of mocha-colored drink at that point that you can't separate at all, actually. Okay, so now that I talked about warm beverages, let me get to, I see there's a handful of questions here. Layla, so if you deducted the amount you put in the traditional IRA from your taxes, comment got cut off. So I will move on to the next one. And so we use this same empty IRA account every year. This IRA is essentially staying empty at the time except for when the backdoor transition is happening. Correct, yes. And that's what I've done myself in prior years. Now, there is I was going to say, I already talked about the 401k, but technically the way the pro rata works, if you do a conversion any point in 2020, let's say, when you're filling out your 2020 tax return on the form 8606 that I showed before, it's going to ask what your traditional IRA balances were as of December 31st, 2020. So it does the prorating, the pro-rata-ness, on the last day of the tax year. If you can somehow get those traditional IRA balances out by the 31st, even if they were in there when you did your conversion, let's say you did the conversion July 15th of 2020, and you had pre-tax money in your IRA, if you can somehow get that pre-tax money out of your traditional IRA by the end of the tax year, you'll be good. But like I said before, your only option to do that is to basically to push it into an employer plan like a 401, because you can't just like get rid of IRA money unless you take it all out, but then you're paying taxes and potentially penalty on it, so that'll kind of defeat the purpose. But in theory, the way pro rata works, if you get your traditional IRA balances wiped out, zeroed out by the end of the year, you won't be hit with pro rata. Cleanest way to do it, as Anwisha's saying, is simply just if you're in this position where you don't already have traditional IRA, keep it empty. Have nothing else in it other than the $6,000 you put in, and then that immediately gets, within a day or so, converted out to your Roth, and just like that account is now empty. That's how you avoid pro rata, is simply not having any other IRA. Pro rata, if you have traditional 401k money, tax deferred, that does not come into play with pro rata. 401ks do not mix with IRAs and vice versa. You can have $10 million in your traditional 401k. As long as you have nothing in a traditional IRA, this whole backdoor thing works. So Leila asked, how does this work? Not sure. I mean, the whole thing, just kind of walk through. If you have or maybe that's an old question. If you have a more specific question, Leila, feel free to follow up. Liliana, no, it does not make sense. LOL. Yeah. I tried to make it as clean and concise as I could. Check out the video on my YouTube channel, Retirement Planning Demystified. It walks through what I'm saying now, but slower pace, it's scripted and a little more methodical in what I'm saying. And I do have follow-up slides, more slides in there that actually show with some numbers the pro rata rule and how this whole thing could bite you if you're not aware of it. Julie, yes, it is empty the majority of the year to avoid dealing with the pro rata rule. Okay, good. And Wisha, can you do this conversion IRA to Roth every month, trying to achieve DCA? Dollar cost averaging, I assume. Yes. There's no law or regulation that prevents you from doing as many conversions as you want. In theory, you can do multiple conversions a day, every day of the year. In practice, your custodian will probably limit you because you'll be a big headache to them if you're converting $5 every day. But yeah, in theory, you can do an after-tax contribution every day and convert it, that same day or the next day, however quickly your custodian will allow it. As far as dollar cost averaging, not to get too off on a tangent, I don't personally believe in it. The theory with dollar cost averaging, if you think markets are going to go up over the long term, then you would not want to drip your money in Just get it in and put it to work. By dollar cost averaging means if you have $6,000 to invest, instead of plopping all $6,000 in today, you'll do 1,000 one day, 1,000 the next month, 1,000 the next month, etc., etc. I don't believe in that. I mean, in hindsight, if you know, looking back, how markets have performed, then yes, maybe that could have been a good idea. Specifically, it helps you if the market is steadily declining as you're putting your money in. So for example, if you invest all $6,000 today and the market drops 20% over the next 6 months, that's a bummer. If you would have dribbled money in every month, then you would have bought at cheaper and cheaper prices. But you would only really dollar cost average if you're assuming or expecting asset prices to drop. And if they are, why would you invest at all? Dollar cost averaging is just another form of market timing, in my opinion, and therefore I don't believe in market timing at all. So I wouldn't advocate it. If you, especially long-term money like this, where you're going to plop it in and probably not touch it for 5, 10, 20 years, whatever, if you assume markets are going to go up over then, just put it all in now. That's not specific advice to you. I'm just saying that that's my view and belief. Feel free to invest as you choose. It's your choice, but I'm just saying in principle, I don't believe in the idea of dollar cost averaging. Shauna, why does the IRS make someone do the back door? What is the IRS logic behind the extra step? Yeah, great question. I don't know. It's probably just not well thought out on their part, and it's probably too much hassle for them to go and rework the tax code at this point to strip it out. Roth IRAs came into existence in 1998, 99 perhaps. I frankly don't know when the ability to do conversions came into play. Let's assume it was also 98. If that was the case, conversions have been allowed then since the inception of Roths, 20 plus years ago. I also think after-tax traditional IRA contributions have been allowed for quite some time. They're two sort of separate things tied to separate products, traditional IRA, Roth IRA. Coincidentally, they work together because anyone can do anyone can do after-tax traditional IRA, anyone can convert. Yes, you string them together, it's as if you did a Roth IRA contribution by way of the back door. So maybe it's just some fantastic loophole that they don't care enough to try to close. I don't have a great answer, but that's a very good question, Shauna. Yep, if I would have scrolled down another inch and a half before I answered, and we just said, isn't a backdoor a newer edition? I think historically it was only front door Roth. Could be. I'd have to go back and see at what point in history conversions started to be allowed, and at what point in the history of traditional IRAs that after-tax deductions started to be allowed. I would think as soon as conversions were allowed, that's when this whole thing, this idea of doing the back door came into existence. Ileana, does this pro rata apply to all conversions or just backdoors? Yes, all conversions. I'll take it a step further. It's not just conversions, it's actually any monies that come out, whether you take a just straight up distribution because you want or need the money, or you convert it, any dollar coming out of your IRA is going to be prorated based on the proportion of balances of pre-tax and after-tax. So it's not specific to just conversions, it's all monies coming out for whatever the reason is. Scrolling down here. A couple comments about the YouTube video. Great, I'm happy you all enjoyed it. Thanks for the kind words. Karen, will companies allow you to keep a traditional IRA open year to year with no balance? Yes, I've done it myself. There's not a lot of administrative cost to keeping accounts open. At this point in the history of financial services, you can even open an account with nothing in it. I've done it for myself and on behalf of clients I work with. Now, I don't know at what point they'd complain at you and say, hey, you need to start getting some money in here, but you can open an IRA or Roth IRA with nothing, and you can keep it with nothing for, there's no particular limit to my knowledge, no IRS limit at least. Again, the custodian may feel otherwise. If it goes, I'm just making this up, a handful of years with no activity, they may reach out and be like, hey, what are you doing here? Anyway. Layla, I was asking about if I took a tax deduction, that money will still be taxed at conversion, right? Correct, yes. So if you took a deduction upon contributing to your traditional IRA, you can still convert that. Nothing says you can't. You'll be taxed at the time of the conversion. So effectively, you're still ultimately paying tax on that $6,000 for whatever you put in. And this goes back to last week. Don't have the slides anymore. Actually, I do. So last week's topic was Roth withdrawal rules. And remember, sorry, the slide is small. But when you take money out of a Roth, it comes out in this order. First is money you put in. Second is conversions that were taxed. Sorry, the camera's not focusing. Might be too small. Oh, there we go. Second is conversions that were taxed. Third is conversions that were non-taxed. Silly autofocus. And then finally is earnings. This is the PDF I posted up last week, that cheat sheet thing. So you can see it there in better detail. That's the difference between taxable and non-taxable conversions. In the backdoor scenario we're discussing today, that is what's called a non-taxable conversion, because you're already paying tax at this step here. Once the money's here, it's already been taxed. So when you convert it, you're not taxing it again. This again, assuming this was empty and nothing else in it, you pay tax here. You don't have to pay tax here. This will be called a non-taxable conversion. Layla's question is, change up this wording, if you make a regular tax-deferred contribution to your IRA, then convert it, yes, you will then have to pay tax here because the money had not yet been taxed as of when it was here. This is called a taxable conversion. That's the difference for purposes of Roth withdrawals between a taxable conversion and non-taxable conversion. You still ultimately pay tax. The difference is at what step did you do it? Were you taxed upon the actual conversion itself, or were you taxed prior to the money getting to wherever it was before you converted it? That's taxable versus non-taxable conversion. Okay, Sarah, if you are in phase out, say you can only contribute $2,500, are you able to do backdoor Roth up to $6,000? No. So I think I know what you're asking. The $6,000 limit, this is assuming people, you're under 50. The $6,000 contribution limit is all contributions of all types across all IRAs. So the question is, if you phase out, you can only contribute $2,500. So let's say you're able to directly contribute $2,500 into your Roth because you're within that $10,000 bound of income limits. Are you able to then do another $6,000? No. You can only do what's the math? Another $3,500 as a non-deductible backdoor process. In total, all contributions to any sort of IRA can be no more than $6,000 for the year if you're under 50, or $7,000 if you're 50 or over. So no, Sarah, in your case, you can only then backdoor another $3,500 on top of the $2,500 you directly contributed. Sergio, for 2019, I put in money into an IRA, then did my taxes. After this, I decided to move it to a Roth IRA so it can grow tax-free. Does this mean I will owe taxes on that $6K for 2019 on my 2020 taxes? There's more potential moving parts than that. You should talk with whoever did your taxes, but you have the ability to recharacterize your contribution. Now, at this point, you might still be able to do it today if you get on the horn with your tax person before midnight. Normally, you can recharacterize up to the tax filing deadline, which is today, to say, hey, for 2019, I did what I put into my regular IRA. I want to instead reconsider it as if I put it into my Roth IRA. Your custodian should be able to do that. At this point in the day, though, good luck making it happen. So you might be stuck with that sitting in your IRA for 2019. You can convert it any point this year if you want to into a Roth. So will you still owe tax on that $6,000 for 2019 on your 2020 taxes? I'm not sure what you mean. Will you still owe tax for 2019 on your 2020 taxes? Sorry. And we should. Very intriguing concept about dollar cost averaging. Yes, the worry is market might progressively go down. Yeah, so this goes to my point. If you're concerned about the market going down, why would you invest anything, right? Um, you're trying to time the market, which is futile. Some people coincidentally get it right. A lot of people don't. Honestly, it's a gamble. So if that makes you more comfortable and less hesitant to invest, by all means do it. But just know that what you're saying is, I feel the market's going to go down, so I'm only going to invest little bits. But if you feel the market's going to go down, why invest anything now? Wait until you feel things are going to go up. But again, nobody knows when things go up or go down. So that's why I feel like it's I don't quite get it, or I don't agree with it, I should say. I know lots of people do, and to each their own. Ken, if my spouse inherits my Roth, can she just rename it as the new owner? If not, does she have to have her own Roth to roll it into, and does the 5-year rule apply? Good question. So first question, if your spouse inherits your Roth, yes, she can rename it as her own. Just pretend it was always hers to start with, basically, and all the rules apply. If she already had her own Roth, her 5-year clock would carry over to what she rolls in from yours. If she does not, I guess that answers your question. So the second part doesn't apply. So if not, does she have to have her own Roth to roll it into, and does the 5-year rule apply? So let's assume your wife doesn't already have a Roth. All she has is yours that she inherits from you. That's a good question. I don't know if the 5 years you had it open while you were alive would port over to her. Yes, I do know this. Yes, it would. If she inherits it, I just discussed this last week. I think I would know this. Just looking at my list here. So the Roth will need to have been open for 5 years in your hands, and then yes, then it'll all be able to come out tax free. Now you'd have to drill down even more, and this touches on what we spoke about last week. Any money you contributed while you were alive, she can always take out. That applies. The only thing she may get dinged with some taxes on, possibly, is if the account wasn't open for 5 years in your name, and she starts withdrawing everything to the point that she's dipping into withdrawing earnings, because earnings come out last, first for contributions, then conversions, etc. She may have to pay some tax on the earnings if the account wasn't 5 years old in your hands. Yeah, but your contributions at least will all come out tax free whenever she chooses to take them out. Mark, I'm getting a little hoarse. Sorry. So Mark asks, I just found out my company offers an after-tax 401k in addition to traditional and Roth 401k. Why wouldn't I just choose the after-tax option as opposed to the backdoor Roth? Seems like less work to get the money to the same Roth IRA. Great comment / question, Mark. Not to plug myself, but I did a newsletter a month or two ago about this. If anyone's interested, it's teninfinancial.com, TENON financial.com. You'll see newsletters there. It may have been May or June. I did a whole write-up on the difference between after-tax and Roth. They sound and sort of look alike on the surface, but they're actually very different things. So an after-tax 401k, here's what happens. When you contribute money to your after-tax, not Roth, but after-tax 401k, the contribution itself is you don't get a tax break on, obviously, because it's after-tax. And it goes into an after-tax account. Well, actually, it goes into your main 401 account. Any subsequent growth on that money is tax deferred. That's considered pre-tax. So that's the downside. Just because your contribution was after tax, unlike a Roth, doesn't mean that your gains are after tax. Any gains in your after-tax 401 are considered tax deferred and stay in your traditional Roth bucket, if you will, tax deferred bucket. Whereas a Roth, money goes in after tax, money grows tax-free, assuming you meet one of the conditions to eventually take it out tax-free. That's the difference. Make sense, Mark? Julia, can you speak about backdoor conversions? There really isn't. A conversion is a conversion. There's only one door, if you will. Anyone can do it. There's no income limits or restrictions on people's ability to do conversions. So there's no need for backdoor. Conversion is simply a conversion. I'm not sure if that's what you meant, but there's no other way or funky angle you have to do to try to do a conversion, because anyone can do one, period. Liana, we did a conversion to maximize the lower tax bracket. Can you discuss more of this pro rata? There's still a large balance on the pre-tax IRA. So if you already did a conversion this year and you already have a sizable pot of tax deferred money in your IRA, you're going to pay tax on probably most of the conversion you did this year, which isn't necessarily a bad thing. I mean, maybe that was your intention. Maybe it wasn't. But check out my video on YouTube. I'm not just saying this to plug myself, but that addresses this whole pro rata thing much better than I'm doing now, because I didn't prepare a bunch of slides and stuff for it. But you can find out more about pro rata there. Again, it's Retirement Planning Demystified is the name of the channel. And it's the most recent video up there is about Backdoor Roth. And we should. Limits for backdoor is much higher. Sort of. So, again, anyone can do a conversion. The conversion isn't really the magic sauce here. It's the ability to indirectly contribute. Contributions are limited at either $6,000 or $7,000 per year. So yes, it's the backdoor isn't just conversion. Backdoor, the name backdoor is the combination of contribution to regular IRA and conversion on the back of that. That collectively is the backdoor. So the conversion by itself is nothing underhanded or backdoorish about it. It is what it is. The getting money in still takes a regular IRA contribution, which you're capped at either $6,000 or $7,000 per year. So the backdoor, if you will, is always going to be limited to $6,000 or $7,000 per year, not because the conversion is the limiting factor, but because the initial contribution to the traditional IRA is the limiting factor. I heard a greater than $50,000 I heard of a greater than 50K backdoor amount. Is that not true? I know what you're probably getting at. So yeah, here's a can of worms. So, and Wisha's asking, so I'm saying the backdoor can only be $6,000 or $7,000 because you're limited by the amount you can contribute to your traditional IRA. That's accurate. So this whole presentation was really specifically IRA contributions, IRA backdoor. You can also do this through your employer plan. Now here's where this is called a mega backdoor Roth contribution. So this is going to get a little technical, but everyone who has a 401k or 403b or TSP or whatever tax deferred employer plan presumably knows that the most you can put in this year is $19,500. If you are 50 or over, there's a catch up of $6,500, I believe, this year. So even though you can only put in $19,500 into your traditional or Roth 401k, you could potentially put in a lot more after tax. And this gets back to Mark's question before. After tax 401k is different than a Roth IRA. They sound the same and look and feel the same on the surface, but they're actually different. The IRS puts a limit on how much total money can go into someone's employer plan on their behalf. And that limit, I think, is $57,000 for 2020, plus maybe the other $6,500 catch up if you're 50 or over on top of it. So that's what? So that's $63,500 perhaps. This is where it gets messy. So at $57,000, that's a combination of your $19,500 that you can directly contribute pre-tax or Roth. It also accounts for employer matches to the extent your employer does match. It accounts for employers' voluntary or discretionary contributions, i.e. not those that require you to put in, but just they put money in for the fun of it for your behalf. And it includes any after-tax amounts. Again, not Roth, but after-tax. Collectively across those four, you can put in $57,000, I think, in 2020, plus another $6,500 if you're 50 or over. So in theory, what Anwisha's talking about is this mega backdoor Roth. That says you would put in potentially $57,000 to your Roth, $57,000 to your after-tax 401k account and then convert that full $57,000 over to a Roth. In theory, it works. Now, there's a few things that come into play. One is, does your employer allow a Roth conversion within the plan, meaning you have money in your after-tax 401 account? Will they let you convert it to a Roth 401 account within the same plan? Increasingly so. A lot of employers and plan administrators are allowing this. Some still don't. So if you can't, then you're kind of stuck. The other option is you have this big pot of after-tax money in your 401. You can roll out to an IRA, but you may not be able to because a lot of employers don't allow in-service distribution. So if you're still working, you probably can't do that route either. So this mega backdoor Roth you're referencing, Anwisha, works in principle, but there's a lot of moving parts that need to all align for you to actually be able to do it. I'll leave it at that because I'm sure I confused most people on this video, unfortunately, because it is this whole after-tax versus Roth thing is really confusing if you haven't really dug into it yet. So Debbie, 401k may permit you to convert from after-tax segment to Roth portion. If you do so ASAP after contribution, you can minimize earnings and move funds into Roth for tax-free. Yeah. So, right, Debbie just summarized much more eloquently than I did over the last 5 minutes how to basically do this mega backdoor Roth. Whatever money you have in your after-tax account, you can, in theory, flip it over to your Roth. You already pay tax on the after-tax stuff. Flip it to your Roth and boom. Just like that, you got money into your Roth 401k by way of its backdoor. Again, that's separate from the IRA stuff. There are two separate limits and some different provisions and rules apply here. All right, so looks like one last question here from Sergio. So yeah, it's too late to recharacterize my contribution for 2019, as you said. They are closed. I changed it to the Roth before the tax filing deadline, but I had already done my taxes. My IRA was completely empty when I put the $6K in before the tax filing deadline. My question is, will I owe taxes in 2020 for this conversion, which was characterized as a regular IRA in my 2019 tax? Got it. I see what you're saying. I changed it to the Roth before the tax filing deadline. Sorry, just reading this again here, Sergio. So you filed your taxes as if it was not yet recharacterized, and then you subsequently recharacterized. I would need to think about this some more, but my initial reaction is you should probably amend your return, honestly. Not today. I mean, you can do it after today, but your return should reflect what you actually did in the tax year. And if you recharacterize it for the tax year, your return should reflect that. So the right answer is most likely you have to, or you should do an amendment. I'll give this some more thought and see if there's a workaround, but my gut reaction is no. Amending the return is the right way to do it, to clean it up. So you don't have to worry about next year, how am I going to do this? Okay. Layla, would you tell us again where we can read the newsletter you spoke about? Yes. Am I able to post comments here? Let me see. Your post. Yes, I can. 1 second. I will post the link. Let me get it. So Layla's question was, where is the newsletter where I discussed after-tax versus Roth? Here it is. Here comes the link. There you go. Yeah, Ileana just posted the, yeah, thank you, Ileana. Ileana posted the link to actually sign up to subscribe to the newsletter. It comes out the first business day of every month at 7 a.m. sharp. But I just sent you the specific newsletter that references the after-tax versus Roth, which was from May of this year. So there you go. Thank you. All right. It looks like that is it. Thank you all. Great questions. Hopefully you enjoyed this. This was one of the trickier ones. Hopefully that slide helped. Again, if you have any other questions, definitely check out the video on the Retirement Planning Demystified channel. That should clear up a lot of the confusion around pro-rata rules. And unless that's it, I will see you next week. Next week's topic is asset location. That'll be a fun one. Everyone knows about asset allocation. That's stocks versus bonds versus cash versus whatever. That's important. In tax planning, asset location is maybe equally important, if not more, perhaps. that says which types of assets should ideally be held in which types of accounts. That's the location of the assets. That'll be next week's topic. So thank you all for joining. I will save this video up on YouTube as well, and it should stay on the timeline of this group for a handful of days, I think, so you can catch a replay there for anyone who's interested. All right, take care. Thanks for watching, and good questions. Thank you.